To see you all here today, to welcome back continuous supporters of the event, and to have some fresh faces joining as well. Special thank you to Clifford Chance for hosting us again this year, and of course to all of our speakers who have prepared some interesting panels for you, and our sponsors and attendees. Since we're getting started just a couple minutes late, I will just kick it off to Julia to begin the session. Thank you everyone for joining and hope you have a wonderful day. Just one last thing, anyone who has questions, just raise your hand and I'll come over with the microphone. So thank you.
Well, hello everyone, and welcome to our annual, I think it's number 4, Women in Structured Finance Conference. It's great to see all of you here, and we're all very glad that you found the time to carve out of your busy schedules today to come and be with us. And we have the honor of opening up today's session with a panel on private capital. What else? Because that's the hottest topic in town, of course. And we picked a few topics that we thought it would be interesting to talk about and get our panelists' views on. But we will start with a brief round of introductions. And then we will kick off. So my name is Julia Zibin. I'm a partner at the structured debt team at Clifford Chance, and I've got 4 amazing women experts on the panel with me today. So starting with Sana.
Thank you, Julia. I'm Sana Murphy. I'm a senior investment manager in the fund finance team at Aberdeen. I have been with Aberdeen for about 2 years now. Previously, I was at JP Morgan for 5 years, and before that at UBS for 10 years. Delighted to be on this panel with all these women that I admire. And yeah, really excited for the discussion.
Hi, everyone, and many thanks, Clifford Chance, for hosting us today. Thank you, Julia. My name is Lia Pozdieva. I'm Managing Director at Ares Management. I've been in the market for 19 years, at Ares for coming up to 3 years, and previously I was with Deutsche Bank and Goldman Sachs in structuring roles.
Hi everyone, I'm Cécile Rotoro. I'm heading private markets at Standard Life, freshly rebranding Phoenix Group into Standard Life this week. I've been at the group for 1.5 years, and before that 20 years in investment banking across BNP Paribas and UBS. Very glad to be here today. Thank you, Julia, again.
Hi, Julia. And last but not least, I'm just looking at my list of job titles. You must all feel a bit sorry for me. I don't know why you've got all of it. Anyway, I normally just go with MD, but Victoria, and you've also got my middle name as well, which no one calls me. But anyway, it's Victoria Gillam, and I am the head of execution legal at Tikehau Capital. Tikehau is a French asset manager, well, originally incorporated in France, but now global pan-European asset manager. In my spare time, when I'm not deal doing, I suppose, I am the co-head of the London office as well. So I'm now spending more time with some of my wonderful ladies up here from an investor standpoint. But my background before I joined Tikehau 9 years ago, coming up for 10 years, I'm a leveraged finance lawyer by trade. So I sort of naturally veer to private credit, but I actually turn my tricks to all the other asset classes as well. And we cover it's private credit, private equity, real estate, and capital markets. And I'm really glad because I think I know a lot of the ladies in the room actually from our CLO platform, which we have in London as well. So it's a joy to be here. Thank you.
All right, so let's kick off. Exciting topics for the day. We wanted to start with some macros first and talk a little bit about what is the outlook for 2026 for private capital, and obviously address the elephant in the room. So how are the external factors like geopolitics and AI and the developments in software are impacting or may potentially impact the market? And we'll probably start with this end. So Sana, if you'd like to kick us off.
Thank you, Julia. So I think one of the ways to frame this year is very much, and excuse me, I'm losing my voice today, so please bear with me, is very much the end of the era of abundant, cheap, cover-light capital. What we're seeing is we're in a repricing cycle. And that is a positive. We think as a disciplined lender, that's very much a healthy place to move into. In terms of AI, that is a live credit risk right now. So we know that there are some stats out there talking about software representing about 25% of private credit. And also, some of you might have seen some research out of UBS last week talking about a tail risk scenario where severe and rapid AI disruption could peak default rates in private credit to 15%. Normally, they trickle around the 2 to 3% mark. So it is a live risk. It's something that's worth keeping track of and keeping an eye on. In terms of geopolitics, I would say sometimes we might like to think in private credit that we're somewhat insulated from the day-to-day volatility that might impact public markets, but the reality is that's not the case. We're not really immune from it. There might be a time lag, but there will be some impact. And the reality is that some sectors and some strategies will have some credit stress as a result, and others will benefit. I think as a lender into the private credit market, we're definitely in the right spot because we can be nimble and focus on the right opportunities. So in terms of trends, I would say we're in a repricing cycle. The next 18 months might start to show us the difference between the true credit underwriters and those that are just capital providers. And in terms of the private credit market, we know it's about $1.8 trillion at the moment. It's going to head well north of $2 trillion. And the next leg of growth and momentum is probably going to be less on the more saturated and mature parts of the market and more into areas such as asset-based finance and specialized strategies.
Yeah. Great. Today is a great day to talk about this as we announced our results, so I can talk to you a bit more freely. So maybe, with that, the best way to kind of analyze the current situation is maybe what has just happened. So if we look at 2025 for us as a firm, we have raised about $113 billion. We deployed about 147, and our AUM surpassed 600, resulting in Ares being included in S&P 500 in December of last year. We're quite excited about the opportunity this year. If you think about private credit as a whole, you have direct lending, you have private infrastructure debt, private real estate debt, asset-based finance, which Victoria alluded to. All of these markets present quite interesting opportunities. For example, real estate prices have corrected, over the past years, meaning, the kind of the V in your LTV calculation is, quite different. Therefore, from the risk perspective, you can find some, interesting opportunities and, structure them for the insurance capital or for private wealth. So with respect to AI, as our CEO, Mike Arougheti, told the market on the earnings call today, we have 25 AI projects ongoing within the organization. So we view it quite an opportunity to improve the efficiency, to improve our productivity from the fundraising perspective, from the operational perspective, and also from the investment perspective, with some tangible tools to enable the decision makers to arbitrate value in the market.
Cecile?
Yeah, maybe I can. Thank you, Julia. Maybe I can bring the LP lens into it and where we focus on. So, if you look at Standard Life, we have like 300 billion of assets under administration, and there is two things that we do very simple. We help our customers save for retirement. So that's how we invest customer savings into the wide toolbox of like public and private markets. And in private, it's from early stage VC to direct lending, private credit. And then we pay an income to those customers at retirement, and that's more the legacy defined benefit that sits on our balance sheet. And this is where we acquire legacy defined benefits onto our balance sheet and invest, let's say, half of it in public market, usually rates and public credit, and then the other half in investment grade, Solvency II friendly private debt instrument, which is, and both sides is very exciting, and on both sides, private credit is very key to our success. The 2026 in that geopolitical environment that has been a bit bumpy, but also in that economical environment that has been bumpy, the software news. From an LP perspective, we have like 3 priorities for the year to navigate that pretty efficiently. First, making sure that we are diversified from a geographical sector perspective, but where we can play on decorrelation in our book. We were very UK-centric, so we're trying to do on our side. The US is a big market. We're not de-risking in the US. We want a book that takes the best of every world sector. I agree with Sana. Like it's back to the credit underwriting, downside protections. Not all software is bad. There is vertical, there is horizontal. There is plenty of opportunities there still. You just need to go back to the underwriting if you invest directly, or select your manager to make sure that you select the best-in-class ones. And that's we have that on twofold. And the last one is we continue to focus on what I call mega trends. When we invest, have in mind that when we invest our customer savings, the weighted average life that we have in mind is 7 to 9 years. When we invest on the back of the income that we need to pay at retirement, we invest up to 50 years, and the target weighted average life is 12 years. So when you have this type of investment horizon, you can't go wrong, whereas you invest through a manager or whereas you invest directly. So we focus on demographic, social affordable housing, critical infrastructure, port, airport, everything that is meant to stay. Energy transition, security, there is plenty to do there. And then digital, we are approaching that cautiously, but we need to be there in the AI forefront.
Last but not least.
Yeah, just to echo, and not to be the super, optimistic, but I mean, the fundamentals of private credit should remain, super positive, right? All the performance indices are positive, and we're outperforming the US here in Europe, both in EBITDA and revenue growth for all of our portfolio companies. The good portfolio companies are performing. Unfortunately, we're seeing on the smaller end of our portfolio companies, that's where defaults have increased, and that's where EBITDA isn't growing as greatly as it would be at the higher end. And we can talk about it, because we'll go on to talk about large cap a bit, but I think it depends in what context of what you're talking about as a smaller deal. As a lawyer, I would say large cap means anything more than 35 million EBITDA. We're just launching a commingled large cap fund, and that's at 75 million plus. So when we talk about large cap, it always has different markers, but by and large, the larger companies are faring better than some of our smaller companies, and a lot of it is sector dependent, right? Business services, technology sectors have been incredibly resilient, not just here in Europe, but also through the US as well. So, it's I think quiet optimism.
That's a good summary to what was just been sort of said by the panelists. So quiet optimism, fundamentals are probably good, but there are some blips sort of along the way. Maybe we should.
One thing, Julia, I was going to mention that there is some aggression coming from the US, which I don't know, to be the lawyer in the room, to maybe mention, is liability management exercises, and these basically ways that, I don't want to be rude about any of our sponsor clients here, but they're really trying to manipulate how they construe their debt and basically how they service all of their debt. So we as credit funds are now, unfortunately, even if it's not a restructuring situation, we're now having to, even at grid stage, we're working through these liability management exercises, LMEs, and putting through those sort of protections into our grids and into our long-form finance documents, even before we're anywhere near, a restructuring or a special ops situation. There's some alarming news coming out of the States. I don't know if anyone's heard about these anti-rebellion clauses. This big Thoma Bravo case, which basically they're saying that if you enter into some sort of cooperation agreement of we as lenders, and we're working together to be clear in private credit, given with all the jumbo deals that are happening now, 2 billion plus, we're going to see some of the ladies have bigger funds than us, but on a bilat basis, we can write tickets of 500 plus. So these are decent sized deals, and some of the US sponsors are trying to do is really kind of stop any lenders acting together through these cooperation type arrangements, and saying all anti-rebellion clauses are to be banned, and if you enter into any arrangement like that, then basically you'll lose your votes. So it's a worrying trend, and it's something we need to be really mindful of, I think, here in Europe, because as all of us unfortunately know, when stuff types like this ebbs into America, it transcends across into Europe. So it's something I'm watching a lot across all of our deals.
Yeah, that's a good point, and sort of very interesting development, because as you say, the US is a much bigger market, and sort of there are lots of things which start then and they sort of cross the ocean and into Europe, and they may not be good for business and good for investors. Maybe it's a good time to maybe drill down sort of into a bit more detail on what exactly are we seeing in terms of the capital deployment, and structural expansion into the traditional bank lending areas and sort of across different asset classes and products like direct lending, fund finance, CFOs, CLOs, special niche capital solutions. So what are we sort of actually seeing in the market? And maybe should we start with the direct lending and fund finance and ABF?
Okay, sure. So one of the things that we're noting on the direct lending market, and bearing in mind that Aberdeen doesn't have a direct lending business, within private credit we're very much focused on more asset-backed type of solutions. So we look at infrastructure debt, real estate debt. We also have private placements, and fund finance sits within that asset-backed financing ecosystem. Arguably, the sort of target market size within the ABF is maybe about $6 trillion in terms of size, and it's still an area that's massively undercapitalized by non-bank lenders. So in terms of the opportunity, it's definitely there. Anything within ABF, you can have a huge variety of sub-strategies. So anything from consumer lending, equipment, real estate obviously fits in that, and also fund finance is part of that space. Fund finance is a very interesting market. It's a huge market that you might not know a huge amount about. There's about $1 trillion of demand annually into fund finance assets, and typically what we're seeing more and more is that the banks can't cater for that growth. And therefore, there's more and more opportunity for non-bank lenders to go into that space. I think one of the benefits of having some of these asset-backed solutions is that you're lending against hard assets or contractual assets with a defined cash flow profile. So from a credit investor's perspective, you've got that downside protection that you're looking at. And in terms of fund finance specifically, parts of the market are senior, secured, over-collateralized, and so therefore from a credit perspective, it presents a really compelling risk-adjusted return story.
Thank you. Victoria, maybe anything sort of that you have to add from your side on large cap lending?
Large cap, like I said, it sort of depends who you're talking to. It depends on what we're defining as large cap. But large cap is great because we get to back some fabulous top tier, right? You have your triangle of your terms, which will come on to your sponsor clients, and then the underlying asset. And in large cap, they tend to be super stellar assets, right? You're talking, 200 million plus EBITDA, really, really well-performing companies in the sectors we all love to be involved in. And the top tier clients who really know these assets. And unfortunately, a number of us now will have gone through workout situations. And when you've gone through a workout situation, partnering with a client who isn't in the top tier bucket, it's a very difficult process, right? So you've two sides of your triangle in large cap tend to be ticked straight away. Top tier sponsor, stellar asset. Unfortunately, you're not getting the best asset with the best sponsor on the best terms, right? So much of what I have to spend my time doing is making sure that we have the right risk apportionment, and with not just sort of. Unfortunately, we hear it a lot in direct lending. It's the race to the bottom in terms of being term takers. To highlight a few points which are, obviously very important to all of us, arrangement fees. In the good old days of a few years ago, would all be set at 2.75%, 3%. Nothing prices at 3% now. Our typical arrangement fee, 1.75, but I'd say about a quarter of the deals we're looking at right now, it's 1.25 to 1. you know, and that's when, like I say, this distinction of what's large cap and what's not large cap really matters when it comes to fees. Same with margin, 5%, you know, you're sort of talking, I actually did a little deep dive into some of our deals to actually tell you what they are. And then the trouble is no one likes to give you all this information because it's, you know, it's quite competitive across the lending geographies. But again, so sorry, I'm not bashing the Americans, but what tends to happen is that really tight pricing hits New York and then it comes into London and then it follows through to the rest of Europe. So, you know, we've just priced a few London deals, thankfully at 5%, but you know, like I say, we're now looking at a bunch which are at 4.5. So, you know, and actually I would query whether those deals are really large cap when you add in all the adjustments and manipulations that come with. No, you mentioned Covlight, but I would say that 50% of the deals that we see in the really large cap space are now entirely Covlight. So, you know, take that or leave it if you so wish. Again, the good thing is about our sort of slightly diversified strategy now is because we've got the dedicated large cap funds, we put the Covlight deals, you know, they can look at those and then they don't really interfere with the rest of the mid-market or lower mid-market strategies. I think it's only 10% of deals now that we're seeing that are all in a full covenant package. So that's a bit depressing because that number was about 40% 2 years ago. PIK features, everyone's favourite topic. PIK toggles, PIK coupons are obviously very, very common. They're ever increasingly common here in Europe. But unfortunately, it's sort of led to the rise of what we're referring to as bad PIK, which you're distinguishing between those borrowers that can really pay their cash and those that can't. My personal favourite of all of these manipulations, if that's what we're to call them, are the add backs. A lot in large cap now, your typical add back is it's not just 25%, it's upwards of 25%. Again, I'm not talking a very long time ago, and that number was 18%, right? So this is something that you really need to monitor. And this, on the last few that I've just papered, we've really kind of had to go to town in discussions around revenue synergies. That's another one. You know, again, it depends on the sector and it depends on the particular company, but if you're running all your revenue synergies through without any kind of cap, that's problematic for us, right? You want to have fundamentally, you need to be able to have a true debt number and a true EBITDA number, and that's, you know, sounds really, really basic, but that's all you're trying to really achieve. So anything that you know, takes away from that is difficult for us. Additional indebtedness, that's proven to be more tricky. The basket numbers, I mean, you only need to go through some of our, and again, not being picking on some of our wonderful sponsor clients, or, you know, more so the debt advisors who put the terms together for them. These basket, you know, I mean, they go on for days now. There are just so many now. We have things called dry powder baskets, which is just, it's like creative ways of essentially reloading your accordion, even though, and it's not run through a leverage test. So it's all of these good things, and I will give a little shout out to my investment teams and me and my team that are embedded within our investment teams. Simply, if you don't know what you're looking for at this stage, remember, we have no counsel when we're papering these deals, right, at these stages. So it's really important that these manipulations are properly identified, and then it's a simple discussion. And one thing I will say to all of our really good sponsor clients, if we have a genuine concern on the lender side, you have a dialogue. You know, if it's a concern for us, ultimately going forward, it's probably a concern for the sponsor as well. So I've yet to come across any of all those things I've just mentioned where if we have a genuine concern, we don't just get on the phone with the sponsor and just discuss it, and it's you find a good solution. So, but yeah, there's some of the things that we do need to think about, and unfortunately, in an ever competitive market, it's difficult to achieve.
Well, sort of maybe going back to the mid-markets and CLOs, I wanted to ask Leah about mid-market CLOs, because you've successfully printed 2 last year. I think the first one was a very interesting deal placed with insurance clients. So what can you tell us about that?
Sure, maybe starting with the mid-market. Our definition of the mid-market is EBITDA 50 to 60 million. We've been kind of the first entrant after the GFC, and we've been doing it in Europe since 2007. We stay true to the mid-market. We think that terms, documentation are better, and I very much kind of, concur on the upper mid-market or with the larger borrowers. But here we're speaking about, we have 7 offices in Europe and we have 600 people in London. You're talking about, kind of 50 to 60 million EBITDA, dentist unions and nurseries and, vets, and we look for stickiness. We look for maybe less price sensitivity. Our co-president likes to say that he's got a dog and he will definitely, go and pay and probably go to the one next to him rather than, kind of price seeking and going to Surrey with his little doggy. And he likes these type of companies. That's what, we're looking out for downside protection. We do less than 3% of the deals that we see with a 90 people investment team out of Europe. So, the mid-market remains, quite attractive, both from the pricing standpoint, so we remain true to our philosophy. And then, kind of the mid-market CLOs are a very natural, as kind of one of the largest players in the mid-market space. You then are able naturally to have kind of 100+ names in your funds, and therefore in the CLOs, which the rating agencies really like from the diversification standpoint and credit quality standpoint. So then you can achieve, kind of cost-efficient financing by looking at both, the public transactions and some of the private transactions, and there are different formats that we have seen the market do to achieve that leverage, both in rated note feeder space, in the mid-market CLO space, and the CFO space, which I think are all useful tools to kind of, I think about it as like a Venn diagram between what the kind of insurance capital wants and what diversified alternative managers can deliver, and these tools just help kind of create a bit more overlap such that we can add value to the insurance community.
I think this is a perfect segue
to the insurance community. I totally agree with what Leah just said, and actually I'm going to bounce back on what Victoria said. So I'm going to just focus for a minute on the private investment grade book that I mentioned when we invest on the back of paying an income at retirement. We need to source and deploy per annum like £3 billion equivalent, and that number is likely to increase and double in the next 2 to 3 years. What happened when the BSL market collapsed versus the mid-market loans, and the illiquidity premium between the two went from 250 bips to 125-ish, give or take what's going to happen now with a bit of like geopolitical volatility and software volatility. Potentially it's going to widen back, but it has not widened that much as of today. What happened in the investment grade world was like complete collapse of that illiquidity premium between the public and the private markets, meaning there is no point in investing in private credit if you don't get that illiquidity premium. So we had to reshape the book on our side and leave the heavily syndicated USPP scene there, potentially keep what we were doing in real asset and infrastructure, commercial real estate lending, but we had to find that relative value without downgrading the quality of the book and with keeping the downside protection that we like. We try to keep a rating equivalent of like A- or BBB+, but that's basically what we're aiming for in equivalent. We don't need to be rated. And the instrument that we expanded into were like the whole scenario of portfolio lending, NAV, fund finance. Then we expanded into securitization, mid-market CLO, but also any securitization would fit the box quite soon. I'll talk about the Solvency II reform, and CFO rated feeders as well. Why? Because you can get access to tier 1 manager top strategies that is not a debt instrument, and package it into a debt format via feeder. And that for us is like how to access high quality strategies, just like in CLO, high quality performing pool that do not qualify for Solvency II. And this is where you add complexity premium to that illiquidity premium, but you also add quality over in your book and not necessarily downgrading your risk. So feeders are going to be even more interesting going forward, because initially we looked at just taking that debt portion and not the full vertical slice of the LP commitment, because it's way more strategic than just leverage or providing leverage. And we're trying to be quite innovative and taking that bulk in the debt investment grade into our Solvency II book, and then the residual, not dump it back to the GP, but say we can take it in our policyholder book in the customer saving that I mentioned. So there is way more like those type of solution conversation between GPs and LPs that goes beyond just like us getting or us investing into private credit or real assets.
Well, I think again, I think it's a perfect segue to my next question about liquidity, and how that drives different structures. So that would be a question for you, Sana.
Yeah, thanks, Julia. So I think it's very topical for us to talk about liquidity given what's going on in the market at the moment. And it's very much an interesting and difficult topic to kind of discuss in detail. But I think the key thing is obviously we've seen the rise of the semi-liquid evergreen vehicles within the space. And it's really important to start by saying semi-liquid does not equal liquid. And really, as an investor, what you really want to be thinking about is how is your GP, how is your manager actually thinking about the liquidity, and how are they offering that quarterly redemption profile if that's the case, and how are they managing the underlying liquidity within the portfolio. So Cecile touched on the liquidity premium. You might have some structures where as part of the portfolio there'll be an allocation to cash or more liquid instruments. That's potentially going to eat into a little bit of your illiquidity premium that you're going to achieve. At Aberdeen, we launched our first evergreen vehicle last year with a subscription line strategy. So that's one of the subparts of the fund finance market. One of the advantages of this market is that it's very short dated, so 1 to 3 year in tenor. It's senior, secured, over collateralized, and your collateral pool is the uncalled capital commitments of high quality institutional investors such as insurers, pension funds, and sovereign wealth funds. And so one of the advantages of using that strategy within this type of vehicle is that rather than having a liquid quarterly redemption profile, we opted for a slow payout mechanism. What that means is that if clients want to redeem, they would be repaid as the loans mature. And that aligns well with a market that's quite short dated, because the portfolio would have a weighted average life of maybe 18 months to 2 years, and that it would be constructed in a way that has a staggered maturity profile, which means there's return of capital every 3 to 6 months. So I think the key thing is, if you're thinking about your manager in the context of liquidity, is understand exactly what the terms are and what that means, not just in normal times, but what your exit will look like in times of stress. And I think a huge shout out to all the lawyers that work hard to add clarity and transparency to the documentation, because I think that's super important, and it's an evolution that wasn't necessarily the case a few years ago. And I think really understanding how the liquidity is managed in the portfolio is important. Is there a bucket into liquid assets? Or are we counting on the fact that these illiquid instruments are going to be sold? And if so, how would that happen? So I think it's a really huge topic. It's a huge part of the market. And it's really important for you to think and understand the proper due diligence in terms of how is this being managed and how is this working.
And maybe final question before we move on to the next topic. Anything sort of that you're seeing in terms of the specific niche capital solutions that you'd like to mention, which we haven't yet talked about?
I mean, I think niche and specialized strategies are seeing more and more interest from investors and from the market. There's a huge opportunity there. I would, cover specifically on fund finance. I mentioned subscription lines. Cecile mentioned also NAV lines. Another area that's seeing a huge amount of interest is GP financing. Again, the key thing here is that these are areas that are not abundant with liquidity, these areas where structural protections are still strong, and these areas where you can still achieve an illiquidity premium that is meaningful. So to Cecile's earlier point, you can still find opportunities of over 100 basis points or 150 basis points of illiquidity premium. So as far as I'm concerned as a lender, I'm very happy to be in the specialized strategies space in this market.
One point on NAV facilities, though, and we're on our third generation now of just about to negotiate. It's really, there's an education piece. I know massively with the NAV providers, we're just going out to 10-year, and I'm not trying to avoid working with many banks, but it's just, ultimately, if I need to explain what a FOLO is anymore, we very much like a number of the panelists, we have our whole lending strategy is we have boots on the ground in all of these various jurisdictions, right? So simply, so much of what I have to know is what do we offer in terms of the Dutch market, how that differs to the German market, and again to UK and whatnot. And so obviously coming up with your eligibility criteria and your buckets for a pan-European direct lending fund is very difficult to do. Simply, it's not a one-size-all-fit. Trying to explain, a buy and build strategy and releveraging and what you're doing and when, and so it's. I believe on the last NAV discussion round, I had it just got to the point where I had to say to the council of the particular bank, who are remain nameless, you need to join. Your leverage colleagues need to join this discussion because simply you don't understand what I do, and I'm just wasting time explaining it to you. So that's why I think we're seeing more and more that there are some really good providers in the market, but it is something that there is this interplay. Then at the end of the day, it's like all of the asset classes. You have to be obsessed with the underlying asset class, and in our case, it's direct lending. So, well, in my case, it's direct lending. So, when you're looking for a provider to help you with your business line, they have to fundamentally really understand the business line. And that's different in every country.
I cannot agree with this statement more because as a structured finance lawyer, you need to know what the underlying is. If you don't understand the specifics of the asset class that you're trying to finance, then you're in very big trouble. On this positive note, maybe we should move on to our next topic, which is the role of insurance capital. And speaking for myself, as a structured finance securitization lawyer by background, I'm very excited that we have new kids on the block, which is the insurance capital. Very much looking forward to them being able to invest in more ABS, because at the moment, or only a very small percentage of the insurance capital assets are invested in securitizations. But more generally, I just wanted to ask Cecile and Leah about the current trends, so what's happening in the insurance markets, how do you view sort of the priority areas for capital deployment for you, so maybe starting with Cecile and then.
Yeah. So it's the UK insurance world is quite interesting because we have two markets on fire, basically. The first one is the bulk purchase annuity market. There is still 1 trillion of legacy defined benefit schemes still sitting at the corporate level, meaning there is the largest UK banks, but also the largest corporate. They still are managing the pension of their employees, and they don't want to do that. So that 1 trillion is looking for buyout into the insurance world where we sit. And that world was a well-behaved world, happy few, until two things happened. One of our friends who were heavily capitalized decided to tell one of the largest UK schemes from NatWest to go for buyout in clips of 10 billions. which requires a huge amount of capital to go after. And they had the capital, but no one else. So us and our friends, like let's say LNG Aviva, were like on the phone, what are we doing? And I'm like, I don't know, we can't compete. So that happens, and then that triggers potentially the interest from financial sponsor and PE firm. That's why you saw 2 M&As last summer with Pension Insurance Corporation and Just Groups, who are now very part of our Happy Few group, and it's going to be very competitive over that last trillion. But it's quite interesting because this is what you're going to see some more partnerships between the insurer and whoever can access differentiated origination in investment grade private credit. What it means is that if you take that 1 trillion, 70% of it is going to go to buy-in, buy-out in the next 10 years. That's 700 billion. Half of it gets invested in private IG or alternatives like securitization. That's 350 billion of new assets that needs to be created. We can't do it by ourselves. We need you guys. So that's why right now we have an hybrid model where we do mainly transaction in-house and let's say 30-35% via manager. I expect that to a bit balance with the huge amount of volumes we will have to do per annum. So we're super excited about that. Second market on fire, defined contribution, workplace, you and me savings. The UK missed the boat on investing in private and alternatives for customer saving and providing enhanced returns to the customers. The UK was mainly like, I wouldn't say passive, but let's say liquid equity strategies plus liquid fixed income and potentially opportunistic, very rare private markets or alternatives. It was the case for us in Standard Life. So we signed the Mansion House Compact at the initiative of our chairman 2.5 years ago. And then the Mansion House Accord, what it says, basically, it says we will invest alongside our peers 10% of our customer savings into private and alternative. It's not a commitment, but it's a commitment for us, but it's not regulation per se. But we're excited about it because it's open VC, it's open private equity, but open the whole spectrum of like real asset on both debt and equity and private credit. And here it's finally the chance for UK insurer to come as like traditional LP plus co-invest, follow what the Aussie superannuation has done, what Canadian pension has done, and be finally there in size as LP rated. You name it, the format, we will find a way, but it's the volume. So far we had like 2 to 3 billion of opportunistic customer savings invested from PE early stage, venture early stage to debt, but right now we're trying to be way more strategic. So we've committed 2.5 billion to a new investment company that we've set up as GP in JV with Schroders Nuveen now, but 2.5 billion is nowhere near 10% of what we have. So it's basically how we partner, how we choose the best in class strategies across GPs and how we build those partnerships. Being late in the game is not bad per se, because we learn from potentially mistakes of like sovereign wealth fund who talk to us and say, don't go into having like 50 GPs, you're going to get drawn into the relationship. Try and be meaningful and more scalable, but don't forget the niche one that are potentially smaller. So we'll do a bit of a balance, and I'm super excited about that. It's for us, we will choose to have not an hybrid model, but full-on manager and potentially discretion on co-invest to commit to the UK a bit more, which is a part of the commitment as well.
And I was just saying, it's our job to really not sell to you, but to really explain why, what we do, we are best in class, and how we can, we different, like say, through, I always think workarounds as much as you don't like living through them. I've sadly spent 2 years in a Spanish situation. And it's I don't know if anyone's tried to enforce security in Spain. It's not easy at all.
I know exactly
thankfully, we had a very cash-generative US element, and we were able to sell it off and managed it. But after 2 years, I can sell to my potential client in Cecile to say, it was 2 years. It was difficult. It was quite a junior investment team, but we got 100 million back and then some, right? And it's only when you've been through these cycles. I was you know, I'm in a different decade this week, guys. I've just had my birthday, but you know, some of our investment team professionals haven't been through the cycles that all of us have been through post GFC. So, you know, it's really our job when and part of my new co-heading job is to really be working with our partners and explaining how our underwriting process works, you know, why it's so key that we have these boots on the ground in all these places and truly understand the relationships with all the partners in those various geographies.
Well, I just wanted to add to say happy birthday, Victoria. Big one, you know, you don't turn 25 every day. So reg change, you know, personally gets me quite excited. You know, I remember I was taking a class in cases in financial engineering at the University of Chicago, and our professor, Pietro Veronesi, great guy, very excited about what he does. He was like, okay, great, Basel III just came out, and you, the class, are gonna spend years try to decompose it, arbitrage it, you know, try to create financial instruments on the back of it. A lot of you know, years since, that's kind of exactly what's happening, and the reforms that have been announced by the European Commission last summer got me quite excited. I was going on holiday, and like they just hit you in July, right, with this new 500-page you know, proposal, and you get quite excited kind of reading it on your vacation. But I think that those changes are quite welcome, because in a sense what they're trying to do is to say, hey, the Americans have their ABF market and securitization market going at 100,000 miles an hour. In Europe, like financing the real economy, the credit cards, the receivables, the assets, your cars, your houses, is just not working very well. And maybe it has something to do with just harmonizations of rules between the Solvency II and the Basel III, and just kind of making it work, which is like really good for the financial system and growth in Europe altogether. So for me personally, it's like, you know, a very welcome change. I would say in practice, you know, kind of large insurers operating, and this is public knowledge, you can look up, you know, any annual report, those with internal models have been quite comfortable, you know, investing in securitization, provided that the returns are there and the capital charges are there, but the capital charge in those examples have not been like a big constraint. But, you know, as the lawyers in the room will attest, the devil is in the details, and just, you know, kind of just making the whole securitization process easier, more streamlined, more transparent, you know, is a very welcome step. I got, you know, equally excited about the Mansion House reforms, as you know, Cecile, you know, unknowingly runs some of my pension savings from back in the day, from those, you know, legacy ex-employers pension schemes that you never looked into, but I'm sure it's going super great. So that is, you know, certainly, you know, very welcome. I looked at my, not the Standard Life one, a different one last year, which I currently have, and I was like, wow, 85% in liquid equities, 5% return over the last 5 years. That's
You can consolidate freely into Standard Life, by the way. It's easy on the app.
To-do list for the day. So investment in private markets out of the pods that are, you know, kind of are invested on your behalf is a very healthy, you know, default. My second favorite professor at University of Chicago, Richard Taylor, gave the book nudge to the, you know, UK government as a summer reading, to that defaults need to be easy and good for people. I.e., like the power of defaults is very important, and I think this outcome is very welcome for the society at large. So from, you know, practical standpoint, I think we will see more, you know, rated note feeders in Europe, more CLOs in Europe. As Julie mentioned, we have done, you know, a couple in the mid-market space, over 20 in BSL in Europe, you know, as a house. And hopefully that will expand into other asset classes to efficiently finance them add rating transparency both to the process and to the insurance balance sheet, which I think is a good thing for the safety of the system as a whole, so that financial analysts, when analyzing an insurance company balance sheet, have, like, you know, full transparency, and you still achieve that pickup that is needed.
And actually, on your point, Julia, on the the regulation on securitization and why it's going to open more. So far, we've been investing in securitization in what we call the hardcore Solvency II matching adjustment with prepayment protection, make-whole provisions, where you're basically asking a pool that has uncertain prepayment and drawdown to fit exactly something that is precise, which is not making it easy. Ares has done it, well done, but it's very hard for most of the sponsors. The Solvency II reform that is coming into play, we were approved, by the way, 2 weeks ago, is going to be not a game changer, but it's going to change largely the world of tax securitization, because we can move from that fixed cash flow world to a highly predictable one. So it's going to relax a bit the terms that we can accept for CLOs, ABS, RMBS, and the wider feeder CFO, ABF. So that we're excited, even though we're limited to 10% of our AMA spread. It's not 10% of the book if you're clever, but it's still a smaller portion.
Step in the right direction. Okay. Well, I think we're sort of at the time now, so this is a perfect statement to end this session on. I don't know, Lauren, do we have time for Q&A, or is it like, yeah, we don't. Sorry. You will have to find us outside and ask all pressing questions, and we'll be very happy to chat to you. Well, thank you so much, ladies. That was very interesting. I've made some notes. I always learn something new and interesting from the sessions. It's been a pleasure to have you at the panel today. I hope you've enjoyed it as much as I have, and thank you so much.
Thank you.
All right, everyone. Well, welcome back, and we are now going to get started with our next panel, the current state and outlook of the CLO market. And without further ado, I'll kick it over to you, Nalin, to begin.
Thanks, Lauren. Hi, everyone. Welcome to this afternoon's session, the current state and outlook for the CLO market. I'm delighted that we have a very experienced and broad panel here to cover a number of perspectives across the CLO market. So by way of introduction, my name is Nolene Ruddy. I'm a partner in the Finance and Capital Markets team in Walkers in Dublin, advising CLO issuers. I'll pass to each of the panelists, with Anna Maria first to introduce.
Sure. Anna Maria Knott from Bank of America. I work in their legal department, so principally working on CLOs and credit asset financing.
Sure. Judith Livingstone, counsel at Clifford Chance here, principally working on CLOs.
Hi, I'm Michelle Manuel from Investec. I'm co-portfolio manager on a predominantly senior CLO and private credit middle market ABF facility portfolio, which spans the US and Europe.
Layla Cole-Morgan, I'm the CLO tranche portfolio manager at PineBridge Investments, a MetLife investment company. I manage $6.5 billion in AUM across US and European CLOs, as well as the portfolio manager on 2 US CLOs ETFs, and we'll be launching an interval fund very shortly as well with Van Eck.
I'm Naomi Prasad, Out to Strategies. I had a lengthy experience in leveraged loans and high yield at a number of different investors, institutional investors, and CLO platforms. And I recently founded Auctus as a provider of sustainability consulting and also interim corporate credit research.
Thanks, guys. And the guys in each of their bios have given a preview of some of the topics we're going to cover. I suppose we're going to, over the next 45 minutes, we'll cover a very broad overview of the market. We'll look at legal and regulatory framework. We'll look at trends in the CLO market. We'll look at market dynamics and obviously geopolitical and macroeconomic considerations. But I suppose turning to Anna Maria and Judith first, no CLO panel over the past 10 years or more since CLO 2.0 would be complete without discussion on the legal framework. So we're currently, when we look at the regulatory framework we have currently, there's some considerations that are relevant for the market generally, some particularly relevant for UK managers, UK investors. So perhaps turning to some of those factors being perhaps divergence between the EU and the UK in terms of the securitization framework. And then on the other side, looking at the EU considerations for Solvency II, which the previous panel has also touched upon, which hopefully will be very positive for the market, particular elements of the market. So passing to the guys for a regulatory overview.
Sure. I think you've really given us a very lovely intro there. So yeah, I think there were 3 things we wanted to focus on in particular. As you mentioned, there's an ongoing European revision discussion There are proposals in the UK rules coming out, and there are actual changes coming in next year as regards Solvency II. So Anna's going to kick us off with the EU position.
Sure. So yes, the EU is, yes, as you say, 10 years. Well, since the securitization regulation came in 2019, there's been a pretty thorough review of how that's been working, whether it's been pro-securitization enough, and there's been various reports on that. So end of 2024, there was the consultation into the functioning of the securitization framework, and then some of you remember there were also the published responses early last year. So the overarching tone of the responses last year was that the requirements of the securitization regulation were disproportionate to the risks associated with securitization when compared to other products. And for instance, that DD could be more principal-based, more proportionate, less burdensome generally. So in that context, we've then had initially the leaked proposals of the Commission, the Commission's proposals for the new legislation, and now the real thing. So we are currently in the middle of what's known as a trilogue process. For those of you unfamiliar, it's the Commission puts forward proposals, and then the Council and the Parliament sort of discuss these proposals and come up with sort of variants of how to move forward with the various topics. So I've just got a few of them very briefly. There's the definition of public versus private securitization, which again you probably heard quite a lot about. So the Commission's come up with a very broad definition of public securitization. So that would capture really everything, including CLO warehouses, which had an EU listing. Then the Council's come back in response to that, and the Parliament, and they've both proposed narrowing this definition. These definitions only really mean anything if you then look at the corresponding obligations, and so there's the whole enormous discussion on what those obligations should be. Should private securitizations have to use a securitization repository? The Parliament thinks probably not at the moment, so there's a bit of divergence there. On due diligence, I think that's where the Commission, Council and Parliament, they have all been looking to simplify, so that direction of travel is looking a bit more united. And then the last topic is I want to mention was the transparency requirements, and again that goes back to public-private. What are we looking at in terms of templates? Is it that the public ones should be cut down by 50%, 30%? Should the private one exist at all? So all of these things are up for debate at the moment.
And what kind of timeline are we looking at to get any of this through?
Well, the timeline is long. It is long. So there's a lot of discussion. The trial process is very thorough. So that will be, we're looking at sort of next year or even sort of the year after for sort of all of these things to be implemented. Perhaps if I can turn it over to you, Judith, for the UK consultation at the moment.
Sure. We've had recent consultations from the FCA and PRA launched together, generally in kind of an exciting and progressive direction if you're a pro-securitization type. The responses to concerns that the current regime is a bit detailed and costly to operate. So there were proposals to simplify things, possibly treat people as grown-ups. It's very exciting. So the starting point is that virtually all the prescriptive rules about due diligence are proposed to be scrapped. It's not to say that nobody has to do their diligence and it will be fine, but it will be less checklist than the current regime. So investors will only have to check the following specifics: that there is sufficient and appropriate alignment of commercial interest between the sell and buy sides, and that sufficient information has been made available to allow independent assessment of the risks of holding, and a commitment to provide ongoing information. There is no specified reporting frequency as compared with the EU set, Greg. And there is deliberately no requirement to check compliance with the UK retention rules, which is probably the big game changer, which opens up the possibility for UK investors to invest in US CLOs, which are not risk retention compliant, and in warehouses which don't have EU counterparties, which would be a great thing. That said, everyone's got policies and procedures in place at the moment for the current regime, and we'd expect that to be where people start from. And we will see things perhaps gradually flex from there. Anna, can you talk a bit about correlated disclosure changes?
Yes, so a few things to note: that it's moving away from prescriptive templates, it's reduced reporting obligations, and this idea of L-shaped retention, all in the context of L-shaped retention being a combination of vertical and first loss. In the context of European CLOs, you have still got the EU regime where L-shaped retention is not being proposed as an option. So all of these kind of UK things that I've just mentioned, they have to be seen in the context of you are going to be having to structure a deal with European investors in mind. There's that, and I think our last topic is Solvency II.
Gal, looking forward to
which is the most agreed.
The most agreed actually happening. And so this is potentially exciting when you look at it, and then we'll see what actually happens. So since Solvency II came in, it's been kind of prohibitively capital inefficient for insurers to invest in securitizations. And the aim of these changes is to make it possible for insurers to consider putting some of their portfolios into securitizations. We'd obviously all be happy about that. I think in context, the difference is European insurance companies are about 1% of investors in securitization markets. They're about 15% in the States. So the changes to Solvency II are changes for spread risk capital requirements. Sorry, I've been learning a lot of maths the last week. But broadly speaking, if you've got a AAA tranche of a CLO, which is a 3-year modified duration, currently that's a spread risk capital requirement of 37.5. That will fall to 8.1%. And a AAA with a 4-year modified duration, the spread risk capital moves from 50% to 10%. It's a really significant change. That brings it down. So if you've got AAA CLO tranche, that's in line with a BBB rated corporate bond, which should give you a really significant increase on the rate of return of investment compared to a corporate bond. If you've got an STS securitization, even happier days. It's still a lot more expensive than investing in a corporate bond. Not necessarily for great reasons, but hopefully this gives us a greater diversity of potential investors, opens up a broader market, greater depth of investors, gives us more CLOs, gives us more things to do. Hopefully things are going in the right direction.
That's a very positive introduction. Thanks, guys. And I think when we all look at the market, there's obviously a desire for revitalization of securitization, and the direction of travel sounds positive. And maybe, Naomi, turning to you, when you look at the market dynamics, the guys have set out the legal regulatory framework, which is arguably moving in a very positive direction. Broad concepts in market dynamics at the moment would include AI, the impact of AI. What is it impact in terms of issuer credit differentiation? You also touched upon in your title, your biosustainability, governance being also a factor. They're very broad topics, but I suppose, how do you see perhaps some of these having an impact on the market, and whether material or otherwise?
Yeah, there are multiple facets to these points. I think AI, like Judith, I'm cautiously optimistic about it. I think it's very easy to go down the existential threat, where Skynet takes over, but I think within the context of what we're doing with the CLOs, we're looking at maybe 3, 5, 10-year horizon. Chances of computers taking over the world and turning us into slaves is pretty slim in that time frame. So I think we need to think about, really examine what risks are applicable to our market first. And they're twofold. You've got the top-down risk from regulation. Do we end up with a sustainability situation where the EU in particular is so busy tying itself in knots, coming up with acronyms, and so much oversight that we just end up getting distracted by it and losing sight of the real issues? And then also from the inside out, what are companies doing with AI? A lot of the risk is going to be coming from, as those AI tools are being developed, are we overly dependent on them? Are we missing opportunities with them? There is a risk of businesses being left behind if they don't actually consider what they're doing and what their peers are doing. I think we've seen a lot of activity in the software sector, where it's AI driven. We've seen a lot of corrections there. That's much more, it's been played out much more in the US market. And that could be because maybe valuations were a little bit on the toppy side to start off with. Maybe there are idiosyncratic names. I think we've seen one particular name in Europe, which is, I don't really want to name names, but if you have a serial issuer, if you have a company that's acquisitive, you've really got to look at that clean EBITDA multiple. It's making sure you understand the fundamental credit. And this is something that I will keep coming back to. It's understanding what you're investing in, really understanding the risks. So when you're talking about AI, it's not just about what can that company do with it, but also how it can be impacted. So that leads you on to how do you manage that risk? And this really is about the sustainability of the business, namely the governance. Right? You have to be able to have confidence in that credit, that they understand what they're doing. Now, this is an evolving market. It's a very new, rapidly growing market, but you need to have someone on the inside, probably on the board or in management, who really understands what the risks might be. And then also you really need some comprehensive and robust policies. You know, it's all very well to say, oh, transparency this, responsibility that, ethics this. That doesn't really mean anything. You've actually got to have something concrete to rely on. Second lines of defense, extra testing, audits, and that really needs to be baked in. And I think, as we go into a market which is more unpredictable, where credits are being tested more, we really need to understand what's going on inside each one of those credits that we invest in.
Thank you. And Leila, on your side, talking about credits and AI generally, how do you view this in terms of the wider implications for the credit market?
I think that we've been asking about AI now for well over a year when we go and conduct due diligence with CLO managers. At PineBridge, the CLO tranche investment team sits within our leverage finance team. So we are actually re-underwriting every single portfolio we're investing in. And we are doing that by being part of a credit analyst team. So by doing that and looking at CLOs on a line-by-line basis, you're able to identify where a lot of the risks are. So we've been asking about AI and how AI might impact various different sectors, not just software. It can be healthcare, auto finance, insurance brokers, a whole lot of different areas which have suddenly come to light. For a lot of other types of investors, we've been looking at this for a long time. The CLO market has been looking at this for a long time. Credit managers have been looking at this for a long time. This is why we began the year in a bifurcated market of 90% of the market was trading above 90 and 10% below. Now we're at a higher percentage, and that doesn't matter where you're talking about Europe or the United States. So the credit market has been considering the impact of AI and really looking at the data. AI works because you're feeding it data and information. The one thing we know about securitizations, and it doesn't matter what type of securitization you're talking about, it's garbage in, garbage out. So if you have bad data, you're going to have bad outputs. When you're looking at AI and any type of company that controls a certain amount of information or a process, the question is always, how proprietary is that data? So if you're taking a look at a publishing company like Argus or Wood Mackenzie, they have proprietary data. That's really important. They actually have people that go and collect this data. That value of that company is within their proprietary data set. If they have their own AI, and this is institutionalized AI systems, you're absolutely good with that. That's fine. But if they were to feed this data into other types of AI systems, that could, again, be good, because that's proprietary, it's good solid data, but it goes the other way around. If your AI system is getting bad data, it's going to get bad results. And then in the current environment, we have to think about who's giving the data. Is the data coming from a malicious entity outside the country, or somebody who wants to spike the data to ruin your company? These are all the types of regulations that still have to be discussed. So to Naomi's point, you have to have people who actually understand how these systems really work at a board level and at a senior management level, and most companies don't. This is why we used to all carry BlackBerries and now we don't. It's when you have people on the board that don't embrace new technologies, you're going to have real problems. So I think that when we're taking a look at the impact on the individual credits from AI, it's not just software, it is across the board. It is about that understanding of the risks and actually what AI really means. So there's still a lot of, that we're doing, but it's, I think coming back from the Vegas conference, and there were different ways of looking at it, there are definitely going to be companies that are going to do this well, and there are definitely companies that are not. Today, what was the headline? That BlackRock had another loan that was marked at 100. Now it's 0. We're going to see a lot more of that.
And continuing on the market dynamic side, Leila, when you mentioned Vegas, one of the trends we're really seeing is an increase in ETFs. So we've reached €1 billion in Europe in ETFs, obviously still dwarfed by the US. I suppose, what do you, and I know PineBridge are investing in 2 US ETFs, what do you see as, I suppose, the changing dynamics that are being brought through from ETF growth in the CLO market?
So we manage 2 CLO ETFs. One is an investment grade ETF, and the other one is a AA to BB ETF. The larger ETF is about $1.35 billion and has almost a 4-year track record. That's CLOI. CLOB was launched in September of 24, and it's about 170 million. Now, we manage some slightly different products than some of the, let's call it, AAA focused ETFs. The AAA focused ETFs are literally used as ATM machines. That's literally all it is. You're getting a higher return than if you were to buy T-bills. And the way that we find a lot of institutional investors, not just retail, a lot of retail wealth management platforms utilize ETFs because and certainly CLO ETFs and high quality ETFs, because it is a higher return than a T-bill, a government type of investment. And there is a lot of attraction for that. The same reason that Solvency II has finally realized they're the only regulatory body in the world that didn't allow investments into securitizations and CLOs. They're still behind the ball. But when you realize insurance companies invest into securitizations, not just 15%. Within CLOs, they are the dominant investor. So insurance companies are really big. 17 or so percent, of, I guess, the AAAs, it's pretty much almost half of all of the rating tranches as you go down the cap stack. It can be up to 70% when you get into some of the, like the single A's. But when you actually look at how important it is, not only do insurance companies, and the big ones invest directly, but the smaller ones use ETFs. The ETFs themselves have an NAIC rating. So when you actually kind of utilize it and say, look, this is a good investment, not just for your insurance company, could be for your pension funds and different types. So the regulators actually say, look, this is a really fabulous product. It goes just from doing that direct investment into the tranches, but then also into the ETFs. So you're getting that ETFs, not just by retail, you're getting institutions. Insurance companies, sometimes there's a catastrophe, there's a fire, you need 40 million, boom. You can liquidate your ETF all of a sudden. You have the money the next day in order to meet claims. It's really very important in the day-to-day running of businesses. And ETFs are a fantastic low-cost way to access the market, have the regulatory wrapper as well, and as well as, again, just providing, I think, not all ETFs are well managed, let's be clear about that, but the ones that are, and there are several, but that do provide a very good option for retail and institutional investors. And I expect that to continue.
Thanks, Leila. And Michelle, that leads nicely to your kind of concept and your thoughts on market activity and primary activity. The guys have set a strong framework for positivity across some of the capital stack, new investors coming in, growth and interest, real potential for opportunities. What are you seeing in terms of AAA investment tightening, double Bs, and as you go through the capital stack?
Well, I think to a large extent it's very technically driven at the moment, and the technicals are very skewed to those AAAs. AAAs, and Leila just alluded to it, are structurally there's a demand imbalance. They're scalable, they are high quality, they're floating rate instrument, and they're globally available. So you have banks, insurers, and increasingly ETFs competing for AAAs. Secondly, they have proven themselves to be resilient across many credit cycles, and I think even now where defaults are kicking up, just the elegance of the structure, the triggers that lead to that early amortization. I mean, speaking anecdotally, we have one that has managed to be failing its junior, its Class D, and its Class C tests, and it's just quite unbelievable to watch the deleveraging of the AAAs, which is where we are. It's quite it's very efficient structure in terms of that. Thirdly, I think they've proven their liquidity. We've had the LDI, which they came through quite clearly. In terms of the competing products, they're still attractively sort of from a spread perspective. And I think, again, to what you two ladies have alluded to, there are regulatory tailwinds, to making them more attractive from that return on capital efficiency. So why does this not feed down to the mezzanine? Well, I think the mezzanine has just that sensitivity to the CCC downgrades and migration, to defaults, and to A&E activity, so you end up not having any certainty around your cash flows. Your core base for your sort of mezzanine are much more sensitive to volatility around NAV and mark-to-market and tend to exit rather than ask questions later, which we're probably seeing right now. And they don't have the regulatory tailwinds. They're not seeing that bid from that long-term balance sheet. And so what we are seeing is that CLOs are still getting done because the AAAs are taken for some reason, the equity's done. But you are putting a lot of pressure on the ARB. There's not a lot of great returns to the equity. And what very clearly we're seeing now is that manager tiering, which Leila alluded to. We see the good managers sort of rising. And that's the current playing field for down the tranche, so to speak.
And leading on from the panel earlier when the guys were talking private credit, that's obviously a huge focus also for CLOs and discussed at every CLO conference. So when you look at private credit and the scale of that potential book that's there, we've had 4 private credit CLOs in Europe. Again, we're at the infancy in Europe, but a lot of consideration over the potential growth for the private credit market. Do you see investors becoming more and more comfortable with private credit CLOs and also the kind of the multi-currency elements of private credit CLOs that have been introduced in more recent vintages in Europe?
Well, I think private credit's very much moved from niche to probably institutional. I think that's very much, underpinned by the fact that you have this long-term permanent private credit capital. It's no longer just a cyclical replacement for bank funding. It's now a core part of a financing ecosystem. Sponsors like it because they like the certainty of you getting their transactions done. I think in terms of investors getting comfortable with it, I think the structures have become a lot more consistent with what the US was. I think the initial one, the Barings, which was a static transaction, was probably very targeted to getting the deal done, whereas they've become a lot more I think even the second Ares ones, which Julia alluded to, was more targeted to insurer and a specific insurance, but now they've become a lot more standardized in terms of the structure. I think we've got a lot more familiar with understanding that it's more of a financing kind of exercise, which from a bank's perspective, where we like the yield, much more certainty around how long it's going to be out when you're at the AAAs, because they typically are very financing, very focused on doing the most efficient kind of deal. You have a lot of alignment because of the retention with the manager, and where you're probably doing with more ABL facilities, you get access to sponsor-backed transactions, indirectly to some extent. So whether they'll become mainstream, certainly, obviously they're much more active in the US and it's much more extensive, but I certainly don't think they'll ever fulfill the role that the BSL market plays. They're a totally different entity. The US is obviously leading because they've got that scale, they've got the depth of manager platform, they've got a very broad and accepting investor base. It's a very standard form of financing. Whereas in Europe, as you said, it's still early, it's growing, but I think we're getting comfortable with certain elements. There's certain elements we still have to get comfortable with, and the fact is it's very concentrated on the platforms. There's a few very large managers, which we've seen, who've managed to come to market. I think the second thing is in Europe to also get a lot more comfortable with the nature and the lack of transparency, which I think the US has got a lot more around. And then I don't think we have been tested to the same extent as the US is currently being tested on accepting the liquidity or the illiquidity of the product, that it's more a long-term product. So I think once we start having those stable, consistent issuance. Once investors start becoming more familiar with it and starts growing out with, and you start seeing it more as a buy to hold product as opposed to, kind of what the BSL would be, we'll see potential, escalation in sort of demand here. But believe me, being an investor in it, we certainly didn't see a lack of demand. It was very well covered by the European investors who particularly liked the deals. So
it's probably interesting for the week in February where we had, the highest issuance for the year and higher than last year. So I think 6.4 billion during 1 week in February. And during that week, we had 9 BSL, 1 private credit, I think 4 resets. So probably a good mix across the market of the activity, but at least 1 billion higher than the highest equivalent week in last year. So very, very significant. But as we know, Leila and Naomi, we prepped for this panel last week, and the world can change very quickly. So when we look at geopolitical and macroeconomic considerations, I suppose it's a very broad question, but I think the market is probably in a wait and see mode, and that's the only mode that we can have at the moment in terms of watching. But I suppose interested in your assessment as regards how the market sentiment is reacting. Obviously, developments in the Middle East will have an impact across energy, inflation, risk sentiment. All of these factors are very material for investors, managers looking to place. So I suppose, are we essentially in a wait and see?
No, not yet. I mean, definitely there are types of investors that will certainly stay on the sidelines and wait. But I think a lot of this ties in together. What we started 2026 with was incredibly tight spreads. There was a lot of technical demand that Michelle mentioned, but you definitely have all of that still there. The problem is that when you get such very tight spreads and it gets, that credit curve is so flat, what happens is that there is a mispricing of risk. And that's literally quite simply what happened. It was a very low volatility environment, and what you saw was that there was literally a mispricing of risk. And that's why when you do take a look, and I think Michelle said it correctly, when you're looking at a private credit or middle market, direct lending, whatever type of CLO you want to call it, CRE CLO, it doesn't matter. When you're talking about an illiquid underlying, where particularly when it's a private credit CLO, where you have no idea what that underlying is, you are buying the underwriting of the issuer. It works definitely for the issuer. It's a financing tool, she mentioned, but it's illiquid. So you have to understand your investment is for that time horizon that it's going to be. And you have to look at it through all of that. When you had private credit being the, last year, companies were coming to the market. They were saying, I need financing. Is it going to be in high yield, leverage loans, or private credit? And private credit's winning it. There's a problem. Because those are the bad companies. If they can't finance in the public company, they're going to private credit. And this is what we're seeing. Private credit had so much money that was being poured into it that they were able to offer cheaper financing vis-a-vis the high yield or leverage loan markets. And that shows you there is an assessment of risk that is wrong. I think what we are now in is this rediscovery of where risk should be appropriately priced. And it's not just the geopolitics, it's the AI, software, however those risks are that you're going to call it, the understanding you're going to own this for a while. So you should really be looking at that risk for a particular time span, 7 years, 10 years, whatever it is. And when you start repricing risk for what it really truly should be priced at, that's where we start getting, I think, a much more healthy market. I think we actually are getting into a much better assessment of those who can ascertain what risk is properly, underwrite risk appropriately, have particular experts that are going to be there to let you know what risk is. And I think, interestingly enough, it does go dovetailing with the regulators, because they have always said you need to have experts in order to assess what the risk is. And I think this is going to be a bit of a mini test for the regulators, for the market. But as we're taking a look at this larger geopolitical spectrum where we're at, I think we're now just simply repricing risk where it should be. It got out of balance, now it's needing to correct. So I think that we are going to be looking at a steeper credit curve. I do think that private credit and direct lending type of securitizations, asset-backed financing, those are going to actually, probably get the types of, yields that they should be getting. They shouldn't be too tight. Again, it's just repricing risk to where it really should be over a credit cycle, and I think that's important to recognize.
Yeah, and I think, from a sustainability perspective, when I talk about sustainability, it's not just about emissions and all that sort of environmental stuff and DEI quotas, etc. It's really about the sustainability of the business. So in a geopolitical landscape, can you actually withstand shocks to the market? Are you in a position to respond to it? Are you in a position to take advantage of maybe mispricing, maybe undervalued or oversold assets? So it's not just about the Greta Thunberg approach. It is really sort of making sure that you're in a position to weather the storm. I think with the current U.S. administration, it is this is a delicate thing to address, isn't it? I could get myself into a lot of trouble. It's unpredictable. It's emotive and reactive. So you have to be, this is the world that we are in right now. So your portfolio needs to be able to respond to that. Make sure that you're not overly exposed to certain sectors, bearing in mind that your need for diversification. And it's also about looking at what sectors are going to be impacted. Obviously it's the oil and gas names, it's the travel names, etc. But we're also looking at, Strait of Hormuz, anything with supply chains. Is this a company that's actually anticipated it? So it's really getting ahead of those risks. And I think the other thing that I would say with geopolitics, the way I anticipate it impacting on our market is we're going to get tighter clusters of issuance. So you're going to get periods where the market's closed, periods where the market's very nervous. So you're going to get these sort of sweet spots, depending on your perspective, where your analysts are running around absolutely can't cope because they're trying to deal with 16 different deals at once. You've got to get ahead of that. You've got to anticipate which deals are going to come to market, which one's going to be refinanced, which ones are looking at acquisitions. Get ahead of your research. So if you're prepared for it, you can make better decisions when that primary does actually happen.
Right. One final question. I think our screens have changed. That might be our hint. Again, we've talked about the divergence in the markets and comparing the US and Europe. Maybe Leila, Michelle, and Judith. I think one point that's very interesting for all of us is, I suppose, the use of LME activity. How does it differ in the US and Europe? And I suppose what's the rationale behind that? Why are we seeing a different approach across LME activity?
I'll start with you, Michelle.
Oh. and I was going to come from the perspective of being the doom scroller, watching this all pass past. I think my 2 cents worth, and it's not going to be as insightful, I think, as Judith's here, is it's really different jurisdictions, it's different approaches to these exercises. And I think right now why it is, I guess, so topical is, and why it's in the news, is these very newsworthy things. It's a little bit like watching Succession or The Godfather, because we now have, the current case in the market, where is the co-op between the creditors, where they are trying to prevent value destruction, now a cartel. You have the lawyers then having conflict of interest because they are trying to sue their biggest clients and having to step back. And I think the biggest issue for this is you have something that potentially can affect not only the US market, but go across to the European market as well, just in terms of contagion there, despite the different jurisdiction approaches. I think from my perspective, where it really does concern us, never mind in the BSL in the US or in Europe, is, and Leila alluded to it, there's a sort of top part of the private credit market that's quasi-broadly syndicated. And I think we've already seen quite think less than a handful, but a handful of high-profile attempts to do LME exercises in private credit where, the history had been this is very much club or one lender, there'll be no LME, and all of a sudden you start seeing these attempts. And I think when you start creating these precedences, which we're currently seeing in the market and where certain things are being tested, this is going to feed into parts of the market that we never anticipated, and the opportunities for taking actions that are potentially destructive to future, the future of this market and the future of lending, and how things potentially price and the relationships between people. I think that would be my 2 cents worth to that.
And this is exactly what you typically hear about Europe. Europe is smaller. It has relationships. It also has laws. There's also some, depending on France or Germany, you actually have legal obligations. So there are, if you happen to be on the board, there's going to be some different outcomes. But one of the topics that we keep talking about, and I think the assessment by us as lenders as well, when there is going to be an LME, we see more and more of this, it is the value destruction. The advisors take out a heck of a lot. So ultimately, your issue is that it's like half or so of all LMEs actually go into default within 2 years. So then you're dealing with the fact your recoveries are lower. Now, we're talking about software where we already know recoveries are pretty low already. And then we're talking about companies that may be impacted by AI and disintermediation. Those valuations also very quickly go very low or to zero. So you've got a lot of this compounding. The question that we've been debating is that this is coming to Europe. What happens when you have a sponsor and they realize there's no reason for me to put any more money in this? or you have the following. It's more of a kind of a private credit type lending. And you happen to have the sponsor, and then they've got the PE fund. They've got to do something. They can't get out of it. Do they throw more money at it, or do they finally throw in the towel? And that's where we have been having this discussion: who gives up first?
I think picking up on the divergence points, there's a huge difference between the underlying market in the States and the underlying market in the EU. If you look at a US CLO, to have 1% of your portfolio in a name is shocking. Yeah. And in Europe, it's pretty commonplace. So you could have a discussion about whether every Euro CLO is really a little bit overexposed to every single name in there. Yeah. I think balanced against that, we've had 5-6 years of really bringing the documents up, thinking about how these events occur in a CLO context where there are vulnerabilities, and actually we have moved the documents to a state where there is a lot more power with the managers than there was previously.
That's great, guys. Thank you. I think we've covered a lot of ground. We've covered broad sector of the market, dynamics, regulatory, a lot of positive indications on the panel. So I suppose the final question would be, a very broad question, the outlook for the year ahead, and a crystal ball, essentially, which is very difficult at the moment. But I suppose perhaps asking each of the panellists for their view as to what 2026 holds, whether in terms of new issuance, volume levels, challenges, predicted new manager launch numbers, open-ended for anyone's view as to what 2026 will hold.
We're going down the line again. I don't really know what to say, because I'll stick to my subject of regulation and say that I think the market response has really been very positive so far to the EU proposals, that have gone back such a long time. And so I think that probably, I know everyone's kind of probably a bit bored of hearing about all these various reforms that have gone on for so long, but I think they are going in a very sort of pro-securitization direction. So I think that's one to look out for.
I'm going to pick up on that very directly. There's an interesting little bit at the end of the FCA consultation papers that recently released, which is a request for feedback on, is a CLO even a securitization? Should it be lumped in with those regulations? Is it actually a kind of leveraged credit fund? Should we be looking at it as something which is run by a regulated entity, invests in products which are originated by a regulated entity, and is very protected in its structure? And it's very interesting to see that debate even open up again.
Well, I think 2026 was going to be a year of strong issuance. You know, it's been very much driven by, there was a lot of refinance activity. There is the positive technical. There was a positive outlook on M&A. I think it's still viable, but if defaults remain constrained, if the financing environment still seems, you know, appropriate. But I think it's not insignificant to take account of the fact of the concentration of technology, the hangover potentially from more looser underwriting, and I think that coupled with, and even the US, you know, private credit fallout potentially rolling into the Europe, but that coupled with the geopolitical risk, I think could cause 2026 to be the theme, the year of reckoning for CLOs, and the resilience of the tranches to be retested again could potentially be the outcome.
Yeah. Yeah. So I'm the downer. I see downgrades. I say an absolute slew of downgrades. The rating agencies are going to make sure they're staying ahead. They're going to take a look at every single one of their sectors. They're going to take a look at every single one of their companies, and they are going to downgrade. And downgrades for CLOs are really bad. We're going to have managers, they've been trying to get ahead of this, but this has been very difficult. The bifurcation in the leveraged loan market and the high yield markets. The problem is we haven't had any meaningful new issuance in the high yield and leveraged loan markets for a few years now, not since 2021. And that particular issuance year has been really bad. We have a lot of stuff coming up in 2028, software loans, tech loans, a whole lot of that matures. So we've got a maturity wall in 2028 and 2029, 1/3 of each of the software sectors matures in each of those years. They're going to be downgraded likely this year. They're going to have to do some sort of an A&E or solution or LME next year to address their 28 and 29 maturities. Does this sound like something from COVID? Let me just remind me, because that's exactly what this is. Because so what we're going to see is we're going to see downgrades. We're going to then see very low actual issuance in the primary market, and the reason is you don't have any new issuance in loans or in high yield. So both of those markets continue to shrink. We're going to be seeing more defaults, very low recoveries, and in addition to that, we are going to see some impairments in the junior tranches of CLOs. So we will see downgrades, but it's, I do believe that, again, the senior structures are going to be fine, but it's going to be messy down below.
I think Leila supports the year of reckoning.
It's the year of reckoning. You were succinct, I was not.
I was sitting on the fence.
Well, without being too much of a Pollyanna about it, I'd like to maybe conclude the panel on a slightly cheerier note. How do we deal with the year of reckoning? Right? And just picking up on a few of those points that have been made over the last 45 minutes, we are in a smaller market in Europe. We are in a market where we're seeing debut CLO issuers. We're seeing, tighter supply. That supply-demand imbalance is tighter. It is increasingly difficult to differentiate yourself as a CLO issuer. And I really would just go back to basics, fundamental credit analysis, really understand and stress test each one of those assets, especially where, as Judith says, the exposure on a name-by-name basis is far greater, just because we've got fewer names to choose from. So I think it is about really being confident and having the conviction, and also the agility and the flexibility to be able to react. So I think it is going to be a year where there's going to be no slacking off. You just have to really keep an eye on things and be ready to move.
I think, yes, superb insights. Certainly a year of reckoning, and I think we've had a great panel, I think, with a broad discussion generally, but also good to have an outlook for the year ahead, as challenging as it is to give at the moment. We have time, I think, for a question or two, if anyone would like to ask a question to the panelists.
You've terrified them.
No, I think she was prepared.
A year of reckoning.
Well, if no further questions, I will just thank the panelists. I think that was superb. Thanks, guys.
Thank you.
right, well, welcome back, everyone, and thank you for joining us for the final panel of the program, which is the ABS Market Outlook. And without any further ado, I will hand it over to Garifalia to begin.
Thanks, Lauren, and thanks everyone for joining us. I know it's the third panel for today, and I know we all love a bit of networking, so glad you came to join us and finish the day. It's a real pleasure today, really, to moderate this panel again, and mainly because we're celebrating the achievement of women in the structured finance space, the impact we bring in. It's great to see more and more women actually involved on transactions from playing different roles than perhaps when I first started in my career, like 20 plus years ago, where less and less women working on securitization deals. So that's, I guess, great to see. And definitely is an area where diverse perspectives make a meaningful difference. So here we are, we play our role there. In today's panel, definitely we're celebrating the achievement of women, and they're also marking the upcoming International Women's Day, because our panel is definitely very international. I'm not going to say where we all come from, but you may guess from our surnames. So today we're bringing an outstanding group of women who are playing a key role in this industry. And we will discuss and share views, as Lauren said, about the ABS market outlook, trends, risk, and opportunities. So let's get started by introducing very briefly our fantastic panel. I will start with Ana Lina Marks, a senior associate at Clifford Chance, with next Ana Cortez Gonzalez, a fixed income portfolio manager and securitized credit specialist at the JP Morgan Asset Management. Then we have Vasiliki Halmuki, director at Securitized Products Group for Lloyds Bank Commercial Banking, and Vasu Goel, head of European ABS and CLO strategy at Morgan Stanley. And briefly intro for myself, I'm Garifalia Ledaki, director at HSBC Issuer Services, leading the sales and business development team across the securitization products, asset classes, but also loans and escrows. So best way to really kick off and set the scene, if you like, is by asking Vasu, given her role really, to help us really set the scene around the ABS market as we see it last year, really, to up to today. So over to you, Vasu, for sharing with us an overview, please.
Sure, thanks. I'm very happy to do that. So state of play in the ABS market, and when I say ABS, I mean ABS, RMBS, and CMBS. I know we had a CLO panel before this, so we'll not touch upon that. But the state of play in the ABS market, I would look at it in the form of three lenses, or through three lenses: supply and technicals, fundamentals, and then where are spreads, where is their value, relative value, and all of that. From a supply perspective, we are coming off a year which saw record volumes in issuance. Last year, not only in CLOs, but combined ABS, RMBS, and CMBS, we did see very healthy volumes getting issued last year. Post-GFC record, in my calculations, the three sectors together, they had issuance just under 100 billion placed issuance in UK and Europe. A lot of it was led by ABS, so auto or consumer securitizations, but sector like CMBS also saw sort of a comeback last year. Even though it's like a small sector in terms of its size, it did see quite a bit of pickup last year from a supply perspective. In my view, I think all of that momentum from last year is going to continue this year. Of course, right now we are in a bit of a volatile geopolitical environment, but my outlook for 2026, which I published at the end of last year, I expected this momentum to continue into 2026. So my forecasts bake in a little over 100 billion of issuance across ABS, RMBS, and CMBS, so about 5 to 7% better than what we saw last year. And also, not only from a supply perspective, but from a demand perspective as well, all of that supply which we saw last year was pretty well absorbed. There was very strong demand from investors. Spreads tightened. A lot of tranches were severely oversubscribed, especially lower down the stack. So all of that supply found homes with investors, and the demand side of the equation was also very strong. From a fundamental perspective, I would say last 3 to 4 years, we saw some challenges because rates went up quite severely. And that translated into a little bit of weakness in certain portions of the securitized market. So arrears levels went up. Some of that translated into pickup in CDR, for instance. A lot of it within the non-prime parts of the market, so non-prime RMBS, non-prime ABS, for instance. CMBS did see some loans, very few, but some loans getting defaulted and getting restructured. So that weakness did translate into, or that those challenges did translate into a bit of weakness in fundamentals. Nothing very systemic, nothing widespread. It was very compartmentalized, I would say. It was in certain pockets of the securitized space in Europe. And I think where we stand today, fundamentals do look a lot more stable. Rates have come down, inflation has come down, affordability is a lot better for consumers. Refinancing risks are a lot lower for CMBS loans. So we are in a more stable fundamental backdrop right now, with the macro situation a lot more stable, even though this week's events does sort of, I'm not sure we can still say that, but broadly speaking, we are in a more stable macro environment, which is good for fundamentals for securitized. Where is their value? Again, we are in a sort of a fluid market environment this week, but if we go back to, say, last Friday before the escalation took place, spreads were super tight in most parts of the securitized universe, especially lower down the stacks in the mezzanine parts of the stack. So that sort of makes it an environment in which, for investors, it is difficult to outperform. But having said that, the securitized universe does offer quite a few interesting relative value opportunities. I'm sure we'll discuss this through the panel, but just to highlight that spreads had been super tight in most parts of the stack and most of the sectors within securitized. And then I'll just add one more thing, and I know it was discussed in the previous panel as well. There were a number of headlines on regulations or the regulatory reforms that have been announced in both Europe and in the UK. And the general direction of those regulatory reforms is positive. So over the medium term, I think all of those should be beneficial for growing the securitized market in Europe. I'll stop there with like an overview. I hope that was helpful.
Thanks. Thank you, Vasu, for setting the scene here and give us this helpful overview. To build on that, I would like to basically throw a fire question to all of you, including myself. Where are we really in the ABS cycle? So first, how will we describe today's ABS market in one word, and why? Shall I start, Julian?
Given it's quick fire, I'm just going to be punchy and say resilient. I think from our vantage point as lawyers, the market has been very, very strong. Sorry. We've seen a number of troubled transactions, but underlying asset performance has generally been quite stable with, as Vasu was saying, overall low delinquencies and defaults. We are seeing many inquiries and new mandates on new asset classes, so in the renewable space, digital infra, sports rights, royalties, as well as equity release mortgages. I think the next challenge for the market, again, as Vasu was alluding to, were the developments over the weekend that will no doubt have an influence on the geopolitical situation. Initial indications that we have seen is spreads are marginally widening, but overall on the transactions we are working on, it doesn't yet have a massive impact. So in short, I think the market has weathered the economic and political challenges quite well.
Thank you. Anna?
So on my side, I would like to say future. As you know, many of you might know, the European ABS market over the last many past years have come at a very difficult situation for many reasons. And Vasu alluded towards this as well. You know, over the last couple of, say, 1 or 2 years, you've seen an increase in supply, and it looks like that investor regulators and originators started to realize what the product ABS securitization means and how it can benefit for the economy, but also how resilient this product is. And on the back of this, people have started to look into this again and taking it maybe from a more positive point of view, looking at securitization. And I really hope this will continue for many years in the future.
Thank you. Vasiliki?
Yeah, pretty much in line with what was previously said. I was going to say rebuilding momentum. We've seen a few tricky years in the ABS space throughout 2010 to 2020, but I think we really, the ship has kind of changed direction. Since last year, we've seen elevated levels in issuance, investors coming back, having real interest, going down the stack, new asset classes. So I think momentum is definitely there. It seems like the market is really turning.
Thanks, Vasiliki.
I would say underutilized would be one word, because there is a lot of scope for securitizations in Europe. The US securitization market is a great example. It's been restricted in Europe because of regulations. So hopefully, with the changes that have been proposed, we should see that shift over the medium term. But yeah, I would say it's underutilized.
Thank you. I would like to involve you on this. And is anyone thinks something else or another description or in one word around the ABS market today that not already covered? Any other thoughts? Anyone else? I think that's really it. But anything from your side? No. Okay, good. So, I mean, I will say, as a summary, resilient, I think that's definitely the one that sticks and I believe is in majority of our minds here. And I want to kind of break it into 3 things, right? One is adapted through different credit cycles, right? 2 will be the recovery after shocks post-global financial crisis reforms. And the 3rd will be the continue to attract investors, really, which means, well, is what it is, right? And then I said 1, resilience, but then at the same time, why this is all happening, why we still have transactions we are still carrying on, because it's essential, is another word, right? It's essential. Emphasizes its role in funding the real economy, regardless the downsides, the upsides, or what is happening. And even now, we are getting questions about, the Middle East conflict, but before was, and is currently is actually still going on, Ukraine, and everything else is happening. But we have gone through, I believe many of us in this room, many events through the years. So resilience, and it's essential. So we're all together to get through once again, I guess. So now, follow up on that, really. Let's deep dive a bit more on what we see in today's ABS market, in the sense of more the asset classes or type of transactions. So, Lena, if I start with you, please, if you can give us a bit more color on that. And what I mean really is what we all see is the traditional versus emerging asset classes, the distinction of private and public. We hear that and we work on those type of deals. And of course, beyond traditional asset classes, right? We see a lot of emerging asset classes that have encountered the last couple of years mainly. So, Lena, over to you, please.
So I think what we saw during the decade following 2008 were that a large portion of European securitizations were kept on banks' balance sheets, or placed with few investors, mostly for capital relief purposes. Over the last years, I think what we've seen that there's been a significant resurgence of public ABS. So if you're looking at the 2024 numbers, which were the ones that I had, we saw a 44% year-on-year increase of transactions being placed with end investors. But despite the resurgence of the public ABS market, what we are seeing is that private securitizations remain very, very important. And we're seeing sponsors and banks executing these private securitizations, either through bilateral deals, club deals, or retained transactions. And that's mostly when flexibility, speed, or confidentiality is required. Mostly private transactions, obviously, are also being driven by investors chasing yield. In terms of assets, what we're seeing, while staple asset classes remain your mortgage transactions, your auto, your credit cards, your CLOs, where CMBS having made a major comeback last year, we are really seeing a push into new asset classes. So 2024 saw the first UK public securitization of data center revenues, as well as the first solar loan securitization. And from our perspective, 2025, 2026 continued on the same theme. So we are seeing data center deals being financed under different rating methodologies, ABS versus CMBS. We are seeing equity release mortgage transactions, both private but also on the public side, and a renewed interest in royalties and sport securitizations. Things that are new in Europe, but sort of going back to what Vasa was saying, much more established in the US. So we are seeing a little bit of catch-up, I think, on the European side. And that is all to say that I think what we're seeing overall is that securitization is quite a flexible funding tool, and that we are seeing a new sort of asset classes complementing the more traditional bank funding and consumer lending exercise.
Thank you. Thank you. Anna?
Let me see what I wrote, down. I think I tend to agree with Helena. I think what I'm coming more from a traditional public securitization side, and over the last 2 years, as you rightly pointed out, so you've seen an increase in supply, and even year to date is the overall supply is higher than we saw last year. Hence, earlier my point also to the future. Now I really hope this trend continues. And what I see, for example, is I saw a transaction backed by lease equipment out of the UK. I cannot recall the last. I'm more than 20 years in this business. The last time I saw lease equipment out of the UK. I've seen a couple of transactions out of Germany with collateral on the consumer side, what I've not seen. So, you see this growing. You see, hence, on the one hand side, you see the originator really recognizing this product again and saying, okay, can I use it for my balance sheet? But on the other hand side, also the demand is there from investor and the willingness to look into this product again, using it as from an asset allocation point of view, and which I think, we've got great times ahead.
Thank you. Thank you. Just very quickly to add on that, around the emerging asset class, I know we focus on Europe, but also I know what's happening in the Middle East side. Middle East also, we see the last couple of years, a lot of transactions, private and also the first actually MBS from Saudi, and the buy now, pay later kind of asset class, but also general consumer asset classes as well. So just to put that into the mix, what we see in today's ABS market. But moving and dipping down, what is driving really the issuance right now among all those asset classes in the space? Vasu, would you like to answer that first?
Yeah, sure. I think it's a combination of factors which is driving issuance. From the investor side or from the demand side, I think investors are recognizing the relative value that the product offers to them. There is cash to put to work. So the demand side of the equation is helping grow all that issuance. And then from the supply side, of course, rates have come down. Lower rates mean more borrowing means more lending means more need for funding. So that's driving the recent growth in issuance. And in addition to that, funding costs have come down. So as I said, spreads are quite tight. So issuers want to tap into those tighter spreads from a funding perspective. But I think also, in addition to being used as a tool for funding, for bank issuers, securitizations or ABS are being used as a tool for balance sheet optimization as well, increasingly. We saw a lot of that happen last year from a number of Euro area banks. So that's also driving, that growth in issuance. And then, as the other panelists were referring to, there are new asset classes which have come, new collateral that is being securitized, solar, data centers. It's still very small in the context of the entire securitization market, but it does lend diversity to the space, I think.
Okay, thank you. Vasiliki?
But yeah, I think for me, stable asset performance is important because it keeps bringing investors back to a product that they know performs well, returns well, so why not? But back to Vasu's point, regulatory capital requirements, I think, over the last, especially after the global financial crisis, have been important in terms of banks, non-bank lenders, fintechs. They all need to be a little bit more nimble as to how they use the balance sheet. You cannot be parking assets on your balance sheet is quite expensive now. So being asset light is kind of the way forward. I think that has driven issuance. And private credit, to some extent, there's a lot of money being thrown in the private space, and eventually, as warehouses fill up, you see that TEN Public takeout in the public space.
Thank you. And stay with you, Vasiliki, and you touched on the private credit, so a follow-up question there. I know we had an earlier panel focusing on private credit, so we will address it in a high level. I don't want you to hear the same things, but obviously, it's a theme, and we see a lot of deals backed by private credit. So, in your view, is private credit a competitor or a complement to public ABS?
I mean, it's one that we debate a lot at the desk, and my view is the truth is somewhere in between always. So it's quite easy to say that private credit is a direct competitor to public ABS because at the end of the day they compete for the same assets, the same asset classes. But I think we need to recognize that private credit, you can get things executed a lot faster than in a public ABS space. You can get more flexible structures. You can do unrated format. You don't even need to do the whole securitization plummet that you need in a public ABS transaction. You can execute in a forward flow format, in a whole loan portfolio purchase format, so it can get simpler. And then you can finance asset classes that potentially don't lend well to the public space just yet. History of data might not be there, or a new originator, for example. So I think that's where they kind of compete. But having said that, I think it's quite helpful as well. You see private credit taking positions further down the stack where public ABS execution is just not there, or it might be harder to do within a week's time where you have to execute a public ABS transaction. So I think it can be supportive, or for originators that are not just TEN Public ABS ready just yet. Personal view.
Okay, all right, thank you. Elena?
I think from my perspective, one of the reasons why I said I think that the ABS market is resilient is because of private credit. So the way we are seeing it play out in transactions is that they're more of a complement to public ABS. So while they sometimes compete for the same assets, as Vasiliki was saying, and clients, in practice, we do see them working hand in hand, and that private credit provides warehouse financing or bridge financing before public ABS takeout. And it also depends on what the investor is after, whether it's more transparency and liquidity of a public ABS, or the yield opportunities and the bespoke nature of private securitizations. And I think, at least from what we see for issuers, it's not necessarily a choice between public and private. It comes down to timing, flexibility, confidentiality, and investor appetite. So we don't necessarily see them cannibalizing each other, but reinforcing each other's growth.
Okay, thank you, excellent. So touch base as well on the non-bank origination as well, the marketplace, basically lending, securitizations, transactions we are seeing. Of course, conscious that they are in the news, references of what's happening with the MFS, of course. Vasiliki, over to you. Could you give us your views around the, let's say, the trends and motivations, or the key risks or challenges otherwise in this space?
Yeah, sure. I think If we take it back to fundamentals, after the GFC, again, the banks have been a little bit more selective as to the segments they want to lend against. And there was a gap in the market that online platforms filled with basically originating consumer and like SME receivables. Obviously, it's one where investors are always mindful as to data transparency, for example, the use of AI. I think all that is quite important. We speak with originators all the time, with investors all the time, and I think servicer continuity, to the extent the platform is not there, is always important, and there's a lot of focus on that. But I think understanding the underlying origination model is fundamental, basically, for these platforms. But to be completely honest, the assets are performing really well. They're short-dated, they yield very well, so there is plenty of investor appetite for that. So this supply-demand seems to work in that space, definitely.
Okay, excellent. So due diligence.
Yeah.
Okay, thank you. Moving on to regulatory, really, theme and landscape. Pass over to you first. Well, if you could address and share a bit of your views, if we are seeing a shift in regulatory frameworks that could either encourage or restrict securitization activity. What is your view, please?
So I think this is like the hot topic for the securitization market since June last year. Since the middle of last year, there's some reforms which have been proposed by the European Commission. Now the European Commission, the Parliament and the Council are going to debate, discuss, negotiate upon all of the proposals through the trilogue process over the next coming few months. And then hopefully before the end of the year, we get a final outcome of that. And again, hopefully the implementation happens sometime next year. The objective is simple. They want to reduce the regulatory scrutiny that securitizations are subject to in Europe by reducing the amount of, for example, due diligence that investors need to do, by reducing the amount of reporting that issuers need to do, and then basically make the ABS market, make the securitization market more accessible to both investors as well as issuers, to reduce those barriers to entry which exist for them. And then there are changes which have been proposed for reducing the capital requirements for banks. So that should drive more bank demand for the product once those changes come through. Already changes have been finalized for insurers under Solvency II. So that was finalized last month and it goes live in January next year. There are quite significant reductions in the capital treatment of securitizations for insurer investors. So that should drive more insurer demand for the product, and as was mentioned in the previous panel, insurers make up less than out of their balance sheets, their assets, less than 1% is securitized in Europe versus around 15 to 20% in the US. And then LCR proposals are also proposed to be changed to be made more securitization friendly. So there are a number of changes that are out there from the European perspective, and then as early as last month, the UK PRA and the FCA also launched a consultation to reform the UK version of the securitization regulation. So there's a host of changes, hopefully, which will be coming later this year, early next year. I think it would help to grow. After a long time, the direction of regulatory changes is positive. And I think it would, over the medium term, help to grow the size of the market by generating more demand and more supply of securitizations.
Okay, thank you. Lina, anything to add on that?
I agree with everything Vasa has been saying. I think specifically in the context of the UK, it's very interesting that the UK securitization framework is being looked at, given that it was only adopted in late 2024. And the Batch 2 consultation that came out last month, interestingly, both the PRA and FCA have said that there would be no grandfathering if the consultation would be adopted. There wouldn't be any transitional arrangements either, because they consider this to be deregulatory, and they think that that will actually have a very, very positive impact on the market. And I think we see that in exactly the same way. one of the things sort of on the asset side that I found personally very interesting is as a result of MFS, I think there's been really an interest of the industry to establish industry-wide standards around due diligence as well as audit rights on borrowers. So I think the expectation is that market players will come together and that at least for the documentation stage, there will almost be an agreed rider in terms of the due diligence that people will look to include at the documentation level, which will no doubt improve the data, especially in the private space. So I'm very, very interested to see the output on that side.
Thank you, Lina. Vasiliki, back to you very briefly around the ESG topic, and especially because of your role and also the asset class you're focusing in auto loans at Lloyds. What's coming for ESG in ABS?
I think we've seen an acceleration more broadly in that renewables, electrification, solar space. And I think over the next couple of years, it's going to move from a niche to more mainstream. And the fact that we're seeing public ABS transactions seems to suggest that a lot more deals that we're getting done in that private space are going to now be open to public investors, available to public investors. I think what we're seeing, what has changed is the approach on the investor side, that they're not looking after a green label anymore. I think that whole labeling, green labeling seems to have fallen a little bit from the agenda, but they're more interested into the underlying collateral, doing the due diligence on the actual portfolios, rather than having someone else verify that deal as green. So I think that has changed a little bit. But looking, for example, from the US, where the market is a lot more developed, I think we're still missing a little bit of that standardization across countries. In Europe, I think the market is quite fragmented still, so it's quite hard to standardize all that. So as soon as we see a shift on all that, I think it will become a little bit more mass market.
Okay, thank you. That's a very good first summary. Moving to the risks topic, I know on our initial fire question we did that basis on the risk by describing it, coming to the conclusion of the resilience is the key word. But what risk we see facing this market, to deep dive a bit more on that, and if you like, is ABS more resilient than corporate credit in downturn? We briefly mentioned the Middle East conflict, of course. The previous panel also addressed that. So what are our views really around risk, global and macro really? Anna, you want to go first?
Yeah, I can. I think in terms of comparing credit to ABS in downturns, I think it would be easy for me sitting here having worked in the securitized market for so many years and say, of course, ABS is the best goal only for ABS. But I guess we need to be a little bit more balanced, because at the end of the day, it's always a little bit of a question: is what downturn are we talking about? Is it more a scenario like 2007, credit risk, or is it more a scenario? We're picking here two extreme scenarios, like in COVID times in February 2020, which was more a liquidity risk. And then when you then go another step and look into the corporate side, what you do there is basically you buy a balance sheet, you buy a business model, and while if you go into the ABS side, what you buy a structure, you buy a pool, and from an investor point of view, you can choose based on what your mandate is, what risk you're willing to take. On my side, from looking into coming from the traditional securitization, also in more on the top of the capital structure, what I've noticed what I've noticed over the last years and going through the downturns is that traditional ABS is typically a lower beta to credit, for example. But what I would like to point out is it is important. It's not a blank securitization as such. It's not good because securitization, but it's really asset class by asset class, deal by deal, depending where you're in the cap structure. So it needs to be looked into from different angles. But when you really look into traditional top of the cap structure securitization, it really shows the resiliency over the last couple of years over downturns, and it could be seen as a lower beta in terms of how it reacts to credit.
Thank you. Asu, your views?
I totally agree with Anna. I think there are two ways to look at it. From a default or a credit perspective, securitizations or ABS have inbuilt structural protection. So it's through tranching, through credit subordination. There is excess spread in the deals to withstand losses. There is so there are these inbuilt. There are some triggers sometimes in deals which get triggered when performance goes to a certain level. So the transactions are built to withstand a certain level of stress, and in that sense, securitizations or ABS are quite resilient compared to corporates. The loss experience of ABS through the GFC has been very limited for European securitizations. So that's a test of the resilience of the space from a credit perspective. It also feels a little less cyclical than corporates. Liquidity, I would say, it's improved tremendously in the past few years. The LDI was a great example. Liberation Day last year was a great example of how much liquidity has improved in the space. But of course, when you compare it to a sector like corporate credit, which is much bigger, it does compare a little less favorably. But I think, having said that, I think it's important to reiterate that liquidity has gone up quite a bit, and it surprised a lot of market participants as well when it happened during LDI. It was a great test of the liquidity of the sector.
Okay, thank you. Any other thoughts on this topic or around risk? I think we have covered pretty much. All right, so I would like to also, before we finish our panel discussion, really to focus on opportunity areas, really, and forward-looking. So I would like to open to all of you the question, where do you see the biggest opportunities in the ABS market? Where is the most growth, really? Is it on the fintech lending? Is it on the SG? Is it on another sector? Is it BNPL? Who would like to go first? Anna, do you want to kick off? Okay.
Happy to go first. I think maybe it's worthwhile to answer this question coming more from a top down. And I think from my point of view, and we discussed it earlier, and Vasu highlighted very nicely, the regulatory framework and currently the review of the regulatory framework. There has been quite something in the securitization market. It was introduced 2019 as taking all the market participants a long time to get used to put it in place. And I think this has been also, while it took a little bit of time, also allowed some investors, to come to the market and look at this market again, because they've got now a framework around. But I think the big opportunity is coming now with the review of this regulation on the European side as well as in the UK. And while it's not finalized, but when I read through the draft comments, it seems like it will allow specific investor groups, which at the moment it's not really attractive for them to look into the securitization market, to go and look again into the securitization market. It will allow, for example, like new originator, like fintech, like you mentioned. It seems like for originator, it simply will allow, again, to look into the market and see, can we use this for our purposes? And on the back of this, it will also allow investors, new type of investors, to look into this market again. i.e., it will allow to create supply, and it will allow to create demand. And this in itself, rather than looking into specific sector, I think will allow the market to grow and create opportunities as such.
Okay, thank you, Anna. Any other views? Any other comments? So if not, I will pose a specific question. If you had to deploy 1 billion tomorrow, where will it go? So Vasu, should I start with you? No pressure.
Sure. I think diversification is the key. Having said that, and this is not a CLO panel, so I will not say that my top pick for 2026 is CLO AAA. I will just put that in. But in the non-CLO space, I think there are some interesting opportunities for relative value. I think the top of the stacks in ABS, for consumer ABS, auto ABS, I think that's quite interesting for investors who want short weighted average life kind of paper. It's very resilient from a fundamental perspective, very resilient from a rating standpoint. I think it's going to benefit from regulatory changes that are forthcoming. So I think, and it's cheap compared to the historical tight levels still. So that's one area where I would put my money, along with probably the CMBS space, where the risk return profile does look a lot more balanced now compared to last 3-4 years. With rates coming down, refinancing risks coming down. So probably the IG tranches in CMBS do look quite interesting. And then if you allow me, then I would probably put some money in Australia as well. Australian RMBS, it's a growing market, and it does offer pickup. A lot of European investors are involved in it, and it does offer, RMBS there offers pickup to European RMBS. 15-20 basis points roughly, let's say, after adjusting for currency. So that's a good place to be. So I would diversify in these little areas.
Okay, thank you. Any other views? If you had 1 billion. Okay, so if we want to a bit more on that theme, where is the most attractive, let's say, return today? Risk-adjusted return, always, of course. Vasu?
The sectors which I just mentioned, yeah, I think the most attractive would be the senior parts of stack, as I said, for ABS, Aussie, CLO AAA. I know it's not a CLO panel, and CMBS, I think, some parts of it. So
excellent. Okay, perfect. Good. So with that forward-looking, let's say, way, we're almost close to our panel discussion, looking at the time as well. So, but before we do, since this is a Celebrating Women conference, really, a summit, also with the upcoming International Women's Day, I would like to close with a quick question to you all. How can we really attract more women into ABS roles, technical ABS roles? I know it's a very generic question, really, because can apply to many other roles in the capital markets, not just for ABS. But happy to hear views on this. Shall I start with you, Lina?
Yes. Maybe my perspective is a different one, given that I work for CC, because I would say the team I work in is quite diverse. I think you have quite a gender balance overall.
Lawyers.
So yes. So I think for me it's more a question on how do you retain women within the ABS space in a law firm, because there may be different pressure points for women in different parts of their career. So for me, for example, one of them was returning from mat leave. I think you don't appreciate that your life completely changes and you can't work in the same way as you did before. So I think having gone through that just now, I would encourage people to have very, very open conversation throughout their career and trying to find the right mentors who have similar views, I think, on how you achieve work-life balance when it comes to it. Not to say that a different perspective isn't valuable, but I think finding the right people to talk to, I think made a huge difference for me over the last year.
Mm-hmm. That's a very good point. Anna?
I think ABS is a great sector. You know, it's vibrant. There's always something going on. You've got so many different sectors to analyze, and there are so many things to do. You know, you can get involved in documentation and in structuring. You know, and basically what you do, the way I see it is I analyze the real economy, right? I look into auto ABS and then thinking, oh, okay, you know, if I would buy a car, you know, how would I finance my car, and how does the pool perform? So it's basically behavioral finance. You know, why all of a sudden are the prepayments going up, and why delinquencies are shooting up or going down? It's you know, you can really drill down into the economy, but it's also fast, and as we mentioned over the last couple of minutes, it's going to change, and in my mind, and I really hope it's going to change for the better, to open up even more opportunities. And you know, lastly, it seems like nice people, so you know, nice people.
Thank you, Vasiliki.
I think to some extent it's also a little bit of an image/perception problem. So people tend to think, oh, ABS is niche, is a bit quant, a bit quirky, I don't know, geeky. So I think unless you see more women working in that, it's a little bit catch-22. And there are quite a lot of women that are employed in ABS these days. So I think it's just maybe fixing that image issue, that you're doing something that is very real. So looking at the portfolio of auto loans, like I work on autos, I find that super, super exciting, to be honest, and other people might find super boring. But to me, you're helping the real economy. I think of it as someone who's actually looking to finance a new car, who has a family and the needs change throughout their life. So I think it needs a little bit more like better imaging to some extent as well. Seeing more women in these panels helps. Personal stories help.
But to increase the overall image, because you're absolutely right. Often when you do securitization law, you sit in somewhere in the corner in the office somewhere. Nobody, yeah, exactly. You know, best behind the door, and nobody sees you. What it comes down to is that the market needs to grow. You know, the moment the market grows, and all of a sudden. It's simply not so easy anymore to ignore securitization, and all of a sudden the guy right there behind the door doesn't sit behind the door but in front of the CFO. You know?
I agree.
It's about market growth, and this is what this market is or has been lacking, and I really hope it's going to change.
I mean, I completely agree with what everyone else has said. I think having senior female role models is, I think, very helpful. Recognizing the work they've done, to have them as, you know, people that you can you look up to, basically. I think that helps, and I think and that's true for, I think, not only securitization but any kind of role where you want more women. Having role models is key, I think.
Okay, thank you very much. I want just to add as well from my side, I mean, if there is one thing comes to my mind is give the opportunity. And that could qualify in many different things. For example, today, big thank you to Clifford Chance, big thank you to Pal Group for having us and getting us all together here to celebrate and organizing really a women-specific, you know, summit, right? That's a starting point. And hopefully everyone will benefit from meeting the role models that you refer to, networking, but equally as women in this space, I believe we are all around this room, give opportunities to other women, right? Let's start from us first, right? And then, of course, by our colleagues, male colleagues. So give the opportunity to people. And give opportunity in an entry point, right? Because I remember once upon a time I started, and I've been given the opportunity. I had no clue, right? It's different in the papers when I did my masters about talking about capital markets securitizations. The real world is a completely different ball game. So give opportunity. Look into this room, for example, in my own team, I believe I gave an opportunity to women, but also a client of ours, I can see, I'm not going to say the name, been given the opportunity to work on a structured fund securitization space. So I think we can all collectively here help each other and the future talent, because I'm not planning to be around forever, as I believe you are not. Yeah, with that note, thank you so much to you all for staying with us, and to our amazing panelists. So thanks everyone. See you all next year.
Right. Thank you to the panel and for a great audience for sticking with us today. And we now have a reception, so please join us outside, and look forward to seeing you at this event next year or a future event in between. Thanks.